After defining the direction of current market trend, the next thing any trader has to do is to locate the key points on the chart that are good enough for opening a position. Trader has to identify the end of correction, which goes against the trend, and open a position in the direction of the current market trend. So, now we can move on to the rules for opening and closing positions. These rules must be precise and clear, no matter what kind of trading strategy we're talking about. If the rules of the strategy are clearly defined, then no more than 5 seconds will be enough for any trader to take a look at the price chart and conclude what kind of position should be opened in accordance with these rules. There cannot be any double interpretations or doubts. All trading rules should be very clear. Trader must clearly understand the conditions under which he has to open a long position and when to close it, as well as the conditions under which he has to open a short position and when to close it. In the face of uncertainty, which is constantly present on the market, as well as because of shortage of time, all trading decisions of intraday trader must be precise and fast. This can be achieved by the precise formulation of rules for position opening and closing. Double barrel gun trading strategy uses a short-term moving average EMA 20 in order to locate position entry points. In addition to generating the true trend reversal signals and filtering out the false golden cross and dead cross signals formed by the pair of long-term moving averages and the price, this indicator also shows the end of corrections that go against the current market trend. Let's consider the initial conditions for a long trade. When the market is developing a correction against an uptrend, the lines of one short-term and two long-term moving averages are starting to converge. Trader can use data window and the crosshair cursor to determine the distance between those lines. At the moment when the distance between the uppermost and the lowermost moving averages is reduced to acceptable minimum, trader must be ready to open a long position. Under conditions when the market is developing a downtrend, the algorithm is similar to the procedure described above. Let's consider the initial conditions for a short trade. When the market is developing a correction against a downtrend, the lines of one short-term and two long-term moving averages are starting to converge. Trader can use data window and the crosshair cursor to determine the distance between those lines. At the moment when the distance between the uppermost and the lowermost moving averages is reduced to acceptable minimum, trader must be ready to open a short position. At the time when conditions for a trade are in place, the main task of a trader is to timely and correctly place all orders required for opening and closing his position. In order to do this properly, trader is recommended to use a bundle of conditional orders, such as if-done orders. If trader opens a long position, then the main order in the bundle used for initiating a trade will be a buy order. The status of this order will be active. Accordingly, two conditional orders used for closing a trade will be one cancelled, the other or OCO type sell orders. The status of those orders will be active upon execution of the conditional order. If trader opens a short position, then the main order in the bundle used for initiating a trade will be a sell order. The status of this order will be active. Accordingly, two conditional orders used for closing a trade will be one cancelled, the other or OCO type buy orders. The status of those orders will be active upon execution of the conditional order. It is quite a simple task to place all necessary orders in MT4 platform. Let's consider the operation of placing a bundle of if-done orders in the following example with the currency pair Euro versus US dollar. First, in the dialog box, select the execution type of the transaction, pending order, the currency pair, and the transaction volume. Then, set the parameters of the main order used for position opening. For example, let's place a sell stop order at 1.1280 price level to open a short position. Then, place a stop loss order at 1.1330 level to limit potential losses, and a take profit order at 1.1230 level to secure potential profit. After placing a bundle consisting of 3 orders and receiving a confirmation, the corresponding information will appear in the terminal window. The following slide demonstrates how this operation is executed in MT4 trading platform. It remains to find out at what price levels the trader should place his orders. To solve this problem, trader needs to know the average range of the intraday price fluctuations of the financial instrument he deals with, or, in other words, its average daily volatility. In addition, it is necessary to point out another important rule of the strategy, related to volatility. Double barrel gun trading strategy works fine only with those instruments that have average daily volatility, sufficient to provide a positive mathematical expectation. Let me remind you that the simplest method to solve this problem is to find an arithmetic mean of the differences between the high and the low of daily candles for the period of a few days. You can also use a fairly common indicator, an index of the average true range, or ATR for short. As for me, in order to determine the average daily volatility of the instrument, I use the following method. First of all, you'll have to build a daily chart of the financial instrument, which covers the history of price changes in the last 200 days. Second, you'll need to build the difference between highs and lows of daily candles in the form of a histogram. Third, apply a simple moving average with a parameter of 10 days to the histogram. At last, the required value can be found by smoothing the line with another moving average as shown on the chart. VMA stands for Variable Moving Average. For the sake of simplicity, I have called this value as Average Daily Volatility, or ADV for short. Please note that it's better to use the ATR indicator with the parameter of 10 days instead of histogram if there are many price gaps on the daily chart of the financial instrument. In my view, to determine the average daily volatility of an instrument, the period between 5 and 20 days should be used for calculation. This is the most logical value because it corresponds to the average number of working days in 1 week or month. On the next slide, shown in the table, are some up-to-date ADV parameters of several financial instruments that are suitable for trading operations conducted in accordance with the rules of double-barrel gun trading strategy. Please note that the volatility of the instrument is constantly changing, and it has to be regularly updated at least once a month. Another important point that should be emphasized in the light of selecting the financial instruments for intraday trading is the ratio of the average daily volatility to the value of the spread in the instrument. In order to increase the mathematical expectation of a trading strategy and gain a statistical advantage in a series of transactions, the trader should trade only instruments with a ratio of 30 or more.